Welcome back to the deep dive. You've given us the sources, the official earnings release, some analyst notes, the data pack from Morgan Stanley's third quarter 2025 results.
Yep, got them right here.
And our mission, as always, is to, cut through all that noise. We want to pull out the 3 or 4 really key strategic insights you need without you having to sift through pages and pages of PDFs.
Exactly. Get straight to the core of it.
What makes this one particularly interesting, I think, is that Morgan Stanley didn't just meet expectations, they absolutely crushed them.
They really did. A significant beat.
Yeah, we're looking at this explosion of profitability. It really outpaced revenue growth, which, well, it suggests something fundamental might have shifted in how they operate.
That's the key question, isn't it? Is it sustainable?
Right. So we're going to break this down using our 5-part framework. It's a step-by-step way to link those headline numbers directly to the underlying strategy.
And that structure is crucial because, look, the press release always aims to put the best foot forward, right?
Nice.
So we need to mesh that official data with what the market was actually expecting, the consensus, to really grasp the size of this outperformance. And then we dig into the why. Why was Morgan Stanley so successful this quarter? Is it proof their whole integrated firm idea is actually paying off when the market winds blow favorably?
Okay, makes sense. Let's dive right in then. Now for slide 1, the at-a-glance scorecard.
The big picture first.
Exactly. The headline results here are, well, they're instantly powerful. Morgan Stanley reported record net revenues $18.224 billion. That's a sharp 18.5% increase year over year.
Pretty strong top line.
Very strong. But the real story, I think, is in the profits. Net income surged, get this 44.6% year over year, hitting $4.61 billion.
Wow. Okay. And the street. They were ready for a good quarter, sure, but I don't think anyone quite saw this coming.
No.
Analysts had pegged the consensus estimate for diluted EPS at around $2.09. Morgan Stanley delivered $2.80.
$2.80. That's a huge gap.
It's not just beating, it's like adding an extra 71 cents of profit per share nobody expected. That's decisive.
And when we talk about that key figure, the $2.80 diluted EPS, sometimes people get confused. Why focus on diluted? Why is that number the sort of conservative one, assuming all potential shares convert? Why does that really validate their strength?
That's a great question. It's really about showing resilience under pressure, even hypothetical pressure.
Okay.
When a company crushes the diluted EPS figure, it means their core profitability is so strong that even if theoretically, every single employee exercised their stock options, every convertible bondholder swapped debt for equity, basically the worst case scenario for share count.
The maximum dilution.
Exactly. Even then, the company would still be generating fantastic profits per share for everyone else. It implies the underlying business is, well, almost bulletproof.
All right, so it's a stress test they pass with flying colors.
Precisely.
And the most compelling thing on this scorecard, for me anyway, is comparing that 18.5% revenue growth to the 48.9% jump in diluted EPS. Profits grew nearly 3 times faster than sales.
That leverage is incredible.
How did they do that? How do you turn, 18 cents more revenue into nearly 48 cents more profit per share?
Well, it was really a two-pronged approach, and it signals fantastic operating leverage.
Okay.
First, love at active capital management, specifically those share repurchases. Morgan Stanley bought back a hefty $1.1 billion of their own stock during the quarter.
Taking shares off the market?
Right. That immediately cut their outstanding share count from about 1,612 million down to 1,591 million. Fewer shares mean the same profit pool gets divided fewer ways, so EPS goes up. It's almost mechanical.
Makes sense. And the second prong?
The second and maybe the more strategic lever was operational discipline. It wasn't just about cutting costs randomly. It was about managing cost growth much more effectively than revenue growth.
Controlling the increase.
Exactly. And that tees up our next key discussion point perfectly.
All right. Moving to slide 2, the engine of profitability.
Right. Because for a big financial institution, it's not just how much money they made, but how efficiently they use the capital shareholders entrusted to them. And that brings us straight to Return on Tangible Common Equity, or ROTCE. This metric just surged. It hit 23.5%. Last year, it was 17.5%.
23.5% ROTCE. That's extraordinary for a global bank this big.
It really is.
Usually see numbers like that maybe from high-flying tech companies. What does that tell us about how management's handling capital?
It tells us they've managed to achieve significant scale, but without getting slow or inefficient. They're squeezing out exceptionally high returns from every dollar of their core capital.
And you mentioned this is powered by efficiency gains.
Directly, it links straight back to that operational discipline we touched on, specifically the improvement in the expense efficiency ratio.
Okay, let's drill into that ratio. It improved by 5 full percentage points, dropped from 72% down to 67%.
Yep, big move.
The concept's simple enough, how much it costs to make a dollar of revenue, but actually achieving a 5-point swing in just one quarter, for an organization this size, that seems like a massive undertaking.
Oh, it absolutely is. Think about it. It means expenses might have climbed, say, 10%, while revenues jumped that 18.5%.
So revenue growth significantly outpaced cost growth.
Exactly. That 5-point improvement demonstrates really profound positive operating leverage. It means the existing infrastructure, the tech, the people they're handling a lot more profitable business without needing a proportionally huge increase in support costs. That's really the definition of scaling effectively.
I wonder, though, how sustainable is 67%? Can we really trust these improved returns?
Yeah.
Or were they just, riding a temporary wave in the capital markets?
That's the critical question, always. Is it structural or cyclical?
Right.
And the source material actually offers some reassurance here. The firm hit this higher profitability level while their tangible book value per share also grew significantly. It went up to $48.64 from $43.76.
So the underlying value of the company increased too?
Precisely. If they were just juicing returns by, say, slashing investment or starving the business, you'd likely see that book value stagnate or even fall. The fact that it's growing alongside the return suggests this is quality earnings improvement. It feels more structural, less like just a temporary market fluke.
Okay, that makes sense. It really sounds like that integrated firm strategy is finally hitting on all cylinders.
It seems that way.
Let's see how the different business lines contributed then. Here's where it gets really interesting, diving into the core businesses on slide 3. The engine room business segment performance.
To specific drivers.
Yeah, this quarter seems to validate the whole idea, right? Both the accelerator part and the stabilizer part were run hot. Let's start with the accelerator. Institutional securities, IS. Revenues there just shot up 25.1%, hitting $8.523 billion.
And you can really pinpoint the fuel for that fire. Investment banking revenue jumped a massive 44%, over $2.1 billion.
44%, wow.
And it wasn't just M&A, though M&A fees were definitely higher. The really explosive growth came from capital raising coming back online, equity underwriting helping companies do IPOs, secondary offerings that revenue soared by nearly 80%.
80%.
It's clear proof the financial markets are wide open for business again.
And it wasn't just the fee-based banking side, right? The trading desks also performed well.
They did. They backed it up nicely. Equity trading revenues climbed 35%, and fixed income trading, even against maybe tougher comps, posted a solid 8% gain. So yeah, the IS division really capitalized across the board on the favorable market backdrop.
Okay, so that's the growth engine. Now let's compare that to the stable anchor, wealth management, WABUM.
The ballast in the ship?
Exactly. This segment generated record net revenues too, $8.234 billion. That's up a very solid 13.3%. Maybe not the 25% growth of IS, but look at the profitability.
Astounding profitability. WM boasted a pre-tax margin of 30.3%.
30% margin.
Yeah, think of this division as the firm's, well, maybe it's insurance policy. That 30% margin comes mostly from stable fee-based revenue. It provides a cushion when those volatile investment banking fees inevitably dip.
And they're still growing assets.
Oh, yeah. They pulled in another $81 billion in net new client assets this quarter. That's money that generates recurring fees pretty much regardless of deal flow on Wall Street.
So the real genius here, the integrated firm model we keep hearing about, seems validated because the revenue from volatile IS and stable WM are now almost equal.
Almost perfectly balanced this quarter. $8.5 billion from IS, $8.2 billion from WM.
That balance seems key.
It's absolutely key to why their overall ROTCE figure can be so high and potentially sustainable. When the volatile markets are hot, like now, IS delivers those explosive market-leading returns.
Right.
And this is crucial because WM provides that massive, reliable 30% margin foundation. The whole firm is seen by the market as lower risk compared to, say, a pure play investment bank.
Interesting. So it lowers their cost of capital.
Fundamentally, yes. It gives them the stability and the lower funding costs to be able to take more strategic risks in the IS division when the opportunities, like this quarter, really present themselves.
That structural advantage. That really feels like the core insight from this whole report.
I think so too.
Okay, let's see how that financial strength then translates into rewards for shareholders. Now for slide 4, financial strength and shareholder rewards.
Right. Because a bank can only deliver these kinds of returns if its foundations are solid rock. And Morgan Stanley's resilience, well, it's quantified by its standardized common equity tier 1 capital ratio, the CET1 ratio. At the end of the quarter, it stood at a really robust 15.2%.
15.2%. How good is that in context?
That's not just healthy, it's well above the regulatory minimums. It represents a huge buffer to absorb potential losses if the economy were to turn down unexpectedly. It's basically their safety cushion.
So a strong capital base.
Very strong. And a management team that maintains that level of capital while also delivering massive profits and returns. Well, that sends a pretty clear message.
And that message, translated into action for shareholders, was pretty clear too. We saw the result of that confidence, the $1.1 billion stock buyback, which directly boosts EPS, plus that generous quarterly dividend declared at $1 per share.
Solid returns.
But I wonder, doesn't that aggressive buyback, $1.1 billion in just 3 months, doesn't that put pressure on the 15.2% CET1 ratio? How do they keep the fortress balance sheet while handing back so much capital?
That's the kind of magic trick of really high profitability, isn't it?
Okay.
It proves the profitability is actually excessive relative to what they need to run and grow the business safely. Their operational success, that amazing 23.5% ROTCE, is literally generating capital faster than they can prudently reinvest it back into organic growth opportunities, even while keeping that huge safety cushion.
So they have more than enough.
They've hit a strategic sweet spot. High profitability is comfortably funding both high shareholder returns and maintaining those high regulatory capital levels. The fact the CET1 ratio stayed strong at 15.2% after returning billions is basically management signaling strong confidence in future earnings power.
That sets us up nicely for the final piece then, management's view. Finally, let's look at slide 5, the road ahead management's outlook and key takeaways.
Wrapping it up.
Yeah. CEO Ted Pick, in his statement, he explicitly linked this quarter's performance back to the long-term plan. He talked about consistent execution of our strategy led to record revenues, and he reiterated their commitment to generating durable growth.
Right.
So the narrative here isn't luck, it's about strategy paying off. A strategy designed to really capitalize on market conditions, just like we saw in Q3.
Exactly. So if we boil the whole quarter down to, say, 4 critical takeaways for you, the listener.
Yeah.
First, this was a massive earnings beat, and it felt structural, not just lucky. Driven mainly by institutional securities really firing on all cylinders, especially that huge 44% jump in investment banking revenue.
Got it. Number 1. Huge beat. IS driven.
Second, the integrated firm strategy looks unequivocally validated. That near-perfect balance between high-growth IS and the super-stable 30% margin wealth management provided both the explosive upside and the underlying resilience.
Number 2. Integrated firm works.
Third, they demonstrated that operational efficiency is a core strength now. Disciplined cost control got that expense efficiency ratio down to 67%. Combine that with the buybacks, and you see how profit growth at plus 44.6% could dramatically outrun revenue growth, plus 18.5%. That's what delivered the stellar 23.5% ROTCE.
Number 3. Efficiency and leverage drove returns.
And fourth, that financial strength translates directly into value for shareholders. The fortress balance sheet, shown by that 15.2% CET1 ratio, comfortably funded those substantial capital returns, buybacks, and dividends. Shareholders are directly benefiting from the operational success.
Number 4. Strong balance sheet enables shareholder rewards. That's a pretty compelling story.
It really is. A strong quarter all around.
It definitely feels like a compelling blueprint for success in this sector right now. And using this kind of structured framework, it moves your analysis beyond just the day-to-day stock price wiggles. It lets you judge if the company's actually executing its long-term plan.
Yeah.
And this quarter, for Morgan Stanley, the answer seems to be a pretty resounding yes.
It does, though it raises an interesting question for you to keep an eye on going forward.
Oh.
Well, management achieved truly exceptional cost discipline to hit that 67% efficiency ratio this quarter, helped by booming revenues.
Right.
If that investment banking surge maybe cools off a bit in the next few quarters, where do they find the next chunk of efficiency gains? Getting even leaner when revenue isn't booming often means tougher choices, maybe impacting core talent or infrastructure. That's the management challenge to watch for in Q4 and beyond.
That's a really good point. the sustainability challenge. Absolutely fascinating stuff. Thank you again for sharing these sources with us and letting us do this deep dive.
Happy to do it. And just remember, this is not financial advice. Always do your own research. This was generated by AI.
Like and subscribe to StockAnalytics.ai. YouTube channel. Members get access to our growing library of all S&P 500 stocks and get priority requests for company deep dives.